Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer.
Well, hey, Jeremy, thank you so much for sitting down and having a chat with me today. So I just wanted to get a feel for, you made the shift. You and I started around the same time in this world of multifamily, and you were doing a lot of what I'm doing, where I kind of do my own thing, work with different operators, different sponsors, different properties. And you've since made the shift to working exclusively with Rice 48. And I just want to hear, what was the big appeal there, and why did you decide to go that route?
Yeah, no, I appreciate the question. You know, my journey really got started probably 20 years ago during the global financial crisis. My wife and I wanted to scratch the entrepreneurial itch, so we started actively fixing and flipping homes. We doubled down on kids, and then we decided we don't have any more time, to invest in actively owning and managing properties. So we pivoted to becoming passive real estate investors really back in 2015. My wife and I have invested in almost 70 different projects now.
Fantastic.
Multiple different asset classes, multiple different, operators. We've kind of done the whole spectrum, right? And so that really gave us a lot of experience in the space, having been passive limited partner investors with different operators to see how they operate internally, also different asset classes in terms of, kind of diversifying our own, portfolio. And so that's really how we got started in the space. And then what interestingly happened, 3-4 years ago, I started getting a lot of inquiries from family and friends that wanted to know about how we were deploying our capital outside of Wall Street and into Main Street, diversifying our portfolio. And so that led us into a position where now we're effectively referring a lot of our personal friends and family to other operators with deals that we were going to be investing our own capital into anyways. And so it was really kind of through that natural progression of us having done it ourselves to us now being in a position where other people are wanting to join with us on these investments as well.
Right. So to that point, we followed the same path.
That's
except
exactly
for the
right.
doubling down on the kids. I didn't go for 4. I stopped at 2.
That's right.
But yeah, okay. So you're doing that. You're getting people into great deals. You've got money in the deals yourself. And then you decided, I'm going to shift entirely to Rice 48. What was that?
Yeah, it's a great question. So because I had such a good experience and exposure with multiple different operators, I really kind of narrow it down to trying to mitigate as an investor a few different risks, okay? There's no such thing as a risk-free investment. Everybody knows that, whether it's Wall Street investing or it's investing in real estate. So I really identify 3 major risk factors. One is operational risk, number 2 is execution risk, and number 3 is market risk. So when I'm evaluating an operator or evaluating any deal, it's really those 3 main things that I'm looking at. How does the operator themselves control all operations? Are they vertically integrated? Do they control all of the on-site employees that are actively managing the day-to-day operations at the site level, right? What about their corporate infrastructure, right? What does that consist of? Are they attracting best in quality, talented employees to execute that business plan? And then, of course, that second risk factor is, of course, executing that business plan itself. And it's not easy to execute a business plan. We primarily target multifamily, B-class workforce housing properties where we have a renovations plan. It's not easy to renovate 250 units over the course of a 2 to 5 year period. I know this because I actively fixed and flipped single family houses. So this is effectively that, just at a much larger scale, right? And so how does the operator mitigate against a lot of the risk factors that might occur? And then of course, number 3 is market risk. Well, the operator can't control that.
Right.
Okay, they can only help to try to mitigate against external market risk factors, things like, for example, the global financial crisis, 9/11, COVID, the historic run up in interest rates. What's the next black swan event going to be? We don't know yet, but there will be something, right? So what does the operator do to really protect and preserve investor capital in mitigating that market risk factor, right? And then, of course, I always like to say there's a fourth one in there, a bonus one, and that is, what's the heart of the operator? So I now, as a seasoned investor, having invested in over 70 different projects with a lot of different operators, I care more about doing diligence of the heart as opposed to diligence of the deal itself, right? And so I want to know, is this an operator that I don't just know, like, and trust? Because I know, like, and trust a lot of people, but I wouldn't know, like, and trust them with 100K of my invested money, right? I want to know more about, their level of integrity, authenticity, transparency. All those things really matter to me when I choose to deploy my own capital with a sponsor.
I'm Zach Kaptenstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Well, that makes sense. That makes sense. And I've invested in 3 deals with Rise 48, and I have found that they have really good reporting, which matters to me. A portal where I can check things very well. Not all operators are doing that. But you discussed market risk. Another thing I look for in operators is one that's not hopping to every market out there.
Yep.
They kind of specialize in a few areas and know those areas very well, because the market may not always be perfect right here. So maybe you want to be able to move over here, but you probably don't want to move all over the planet, because like you said, if you want that vertical integration, you have to have a team in place.
That's it.
And you can't just pick up a team of 100 people and move them to a new market. So you'd have to build a new team from scratch. So what does that look like at Rise 48? Where are their markets? Where are they specializing in? How are their teams built there?
Yeah, great questions. Lots of good questions there. I like to let investors know that our buy box is very boring. Okay, we're primarily targeting that B+ class property in a B+ class neighborhood. Most of our tenants would be that workforce housing demographic, which is the largest demographic of the population in the country today. But when we're targeting a particular, market location to maybe move into, right, we're looking at some fairly key, metrics, things like strong job growth, right? We want to be in markets where there's good paying jobs, where people want to move into. Employers are spending money. Maybe government is spending dollars in those markets really to improve the economics of that local population base and labor base, right? We want to see good in-migration, right? Our tenants actually moving into those markets, maybe from other, markets across the country, right? So there's a couple of things that we look at, but the major thing to note is that when we enter into a new market, we're not just going to enter into a market and buy one property. We want to build out an entire infrastructure there. So we operate primarily in Phoenix, Dallas, and North Carolina. Across those 3 major markets, we have over 12,000, doors that we manage today. Just about $2.6 billion as of right now in total real estate across that portfolio. But your point is valid in that we want to mitigate risk for investors, and the best way to do that, from our perspective, is to have a very skinny buy box. We're not focused on asset classes that we don't know anything about. We're not focused on assisted living or self-storage or industrial or flex office or retail, because those are not asset classes that we can really drill down, dial down, and execute a business plan on time and on budget.
That sounds great. Sounds great. So in that closed buy box, what does your team and infrastructure look like at Rise 48? How many employees are there? Where are they positioned?
Yeah, great question. So we currently, as of today, we have over 325 full-time W-2 employees. We really have 3 separate companies within Rise. We have our investment company, Rise 48 Equity. That's primarily where most of our corporate staff is located in Scottsdale, Arizona. We also have our property management company, which is called Rise 48 Communities. And that is where all of our in-house W-2 full-time employees that are managing the day-to-day at the property level. So employees like the maintenance technician, the community manager, the property manager, the leasing agent, right? All of the employees that are on site at each of our properties across 65 different assets right now are all our own in-house W-2 paid employees. Why that's important is because we control attracting the talent, and we can align their compensation and their incentives to the actual business plan itself. So we can ensure that we're carrying out the execution of that business plan and mitigating, that risk factor, for investors. And then our third company is called Rise 48 Construction, and that is our construction management company. Rise 48 has our own GC license in-house. We source all of our materials wholesale through suppliers like HD Supply and Builders Warehouse. And that really allows us to control our supply chain, because we're not just managing and executing the business plan of hundreds of units renovating per year. It's thousands of units per year that we're renovating. And that really allows us to achieve that economies of scale.
I remember I was doing a raise with you guys just after the COVID thing, and people weren't able to get the supplies they needed.
Yeah.
They weren't able, so they'd have this great plan, we're going to renovate all these units, but they couldn't get cabinets, they couldn't get appliances. And you guys had them already sitting there in a warehouse at pre-COVID prices, because the prices also went skyrocketing when it was hard to get things. So I remember that about you guys and why you're able to come in lower on some things because of that that scale of operation there. So are you guys still sourcing things overseas and bringing them in and hosing them in warehouses, or are you bringing them straight to the site? Because I know it's a different time now.
Yeah, no, absolutely. So we have, like I mentioned, we have contracts with HD Supply and Builders Warehouse. That's where we primarily source the bulk of our materials, is through those main two suppliers. Most of the supplies come from countries like Taiwan, and Vietnam, and we have local warehouses in the three major markets in which we operate. So that's where the materials come, into the U.S. Those warehouses are stocked with plenty of supply. In fact, at any given time, we have anywhere from 12 to 18 months of supplies ready to execute at any given time. One other example outside of kind of that COVID era is elections have pros and cons. And so we predicted that President Trump was going to win the election. And in September, before election, we knew that if Trump was elected, more than likely the topic of tariffs was going to come back again. And that can have a material impact upon the cost of goods and services, depending upon the country in which those tariffs might apply. So we met with HD Supply and Builders Warehouse, had them into our offices, and they basically built up, in advance of election, they built up an additional inventory of supplies, knowing that we wanted to fix in those costs on the front end in the event that the impact of tariffs would have a potential increase on those pressure of those supplies, if that makes sense.
So when you're doing that, you're also doubling down on the fact that Rise 48 isn't going to slow down. You're not going to stop buying stuff.
We're not going to stop buying stuff. We're going to continue to execute our business plan across our portfolio. And we're really I would say we're more in an attack mode right now, because we're at a down point in the market cycle. Just like with Wall Street, real estate has market cycles, and we're in one right now. The peak of the last market cycle was felt back in 21 and 22. Right. And right now, today, we're buying properties at a 30 to 40% discount on their original basis on what those properties would have transacted for, just 36 to 48 months ago. And so it's a buyer's market, and we're taking advantage of it being a buyer's market today.
We're here at the Best Ever Conference in Salt Lake City, and I was just sitting in on one of the economic market trend presentations, and basically all arrows are pointing, if you want to believe the economists who are right about 51% of the time, they're doing a good job. But nonetheless, it seems like all the arrows are pointing that we have hit that bottom, that it is theoretically, can't make any promises, but that we are now going to be on the uptake, and interest rates are kind of pointing that way. Buying power of people in the economy are pointing that way, and the stabilization of properties and cap rates starting to drop just a little bit are kind of showing that. Do you believe that's true? Do you think we've hit the bottom and we're going to come up?
Yeah, I mean, typically market cycles last a few years, right? And if the peak of the last market cycle was felt in, the back half of 21, first half of 2022, you extend that out now, and we're kind of getting to that point right now where we're starting to see things start to shift today. Transaction volume of severely distressed deals are really hard to come by today because the ones that were severely distressed have already changed over now, right? And so we're not seeing those types of distressed deals where we're buying properties from deals directly from the bank, from sellers that have deals in foreclosure. So we're just not seeing that type of transaction velocity today like we were historically the last 36 months. But we're also starting to see positive signs as it relates to concessions. We're also starting to see organic rent growth start to trickle back into the markets again, which of course is a positive sign for us as well. So the other big thing, outside of interest rates, outside of concessions, the real big one is supply, right? And so depending upon the market, right, there was a wave of new supply that hit a lot of the markets, especially in the Sun Belt regions in the aftermath of COVID, because cost of debt was super cheap. So developers were able to secure financing at significantly lower costs historically. And then you had a lot of in-migration and immigration during that time period. And a lot of people were flooding into a lot of these Sun Belt states. And so you had a lot of new supply. Demand or absorption was also historically high, right? But at some point, eventually that needs to burn off. It's economics 101. It's a supply and demand thing.
Right.
And so in the markets in which we operate, we're starting to see that new supply really fall off a cliff. And when new supply in the market falls off a cliff, but demand or absorption still remains, relatively high or moderate, eventually those units get absorbed, which helps burn off concessions, which helps bring organic rent growth back, which helps increase the value of properties.
That's one of the reasons I don't invest in new construction typically. Not saying I never would, but you see the demand is high right now. You're like, I'm gonna go build. Well, your build is ready in 3 years.
That's it.
By the time you buy the property, get the permits, get everything vertical, and by that time, everybody else had seen the same thing, done the same thing, and so yes, we had an oversupply issue. But because those interest rates also went really high, nobody wanted to build anymore, and they're still not really building new anymore. So I'm sure we'll go through another one of those market cycles, as you said. So,
That's right.
Well, thank you so much for taking the time and sitting down with me and discussing this today. I really appreciate it.
Pleasure. Yeah, thanks for having me, Maria.
All right, take care.
Thank you.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.